What is financial security? Financial security is the state of having sufficient assets to provide for one's living expenditures, protection against unforeseen events, and retirement without the need to worry about depleting those assets. The vast majority of people are unable to demonstrate financial security, particularly for the years in which they will be retired, according to almost all of the study that has been carried out on the topic in the recent past few years. This simply serves to further emphasize the reality that establishing financial security is a difficult process that needs meticulous planning and consistent execution of those plans. So, what should you do to secure your finances? Welcome to Abon V. In today's video, we're going to be talking about 10 tips for achieving financial security. So, stick to the video, keep watching, and let's dive in. Number 1. Get started as quickly as possible. It goes without saying that it's preferable to begin saving from a young age. However, it's never too late to begin, even if you are already getting close to the years in which you will be retired, because every cent saved helps to pay your expenditures. If you save $200 per month for 40 years at an interest rate of 5%, you will have saved a substantial amount of money over that time. This is in comparison to an individual who saves at the same rate for 10 years. On the other hand, the amount of money saved in a shorter amount of time can go a long way toward helping to cover expenses during retirement. Additionally, keep in mind that as you approach retirement, other aspects of financial planning, like asset allocation, will become increasingly crucial for you to focus on. This is because, in general, your risk tolerance will drop as the number of years in which you can make up for any losses reduces. Number 2. Consider your savings deposits to be a form of payment. Putting money aside consistently can be difficult, particularly when you consider the numerous repeated costs that you have to deal with and the consumer products that encourage us to spend our spare income instead of saving it. You can avoid giving in to this temptation if you consider your retirement funds to be an important expense, just like your rent or mortgage or car payment. If the sum is taken out of your paycheck automatically by your employer, this process will be considerably simpler. You can also have the option of having your pay deposited directly into a bank or savings account, which can be done instead of taking it out of your paycheck automatically. Number 3. Establish a tax-deferred account for your savings. Because you will likely be subject to tax implications and penalties if you spend the money that you have set aside for your retirement before it has been deposited into a tax-deferred retirement account, you will be less likely to spend that money on a whim. For example, if you withdraw money from a traditional retirement account, that money might be subject to income taxes in the same tax year that it was taken out of the account. In addition, if you are under the age of 59 and a half when the distribution is made, that money might also be subject to an early withdrawal penalty of 10%. If you have sufficient income, you should evaluate whether or not you can boost the amount of money you put away in tax-deferred accounts. Consider, for example, whether you can afford to save money in a retirement plan offered by your employer, in addition to saving money in an individual retirement account, also called IRA, and whether the IRA should be a Roth IRA or a traditional IRA. Number 4. Make sure your investments are diverse. When it comes to retirement assets, the age-old proverb that advises us not to put all of our eggs in one basket is one that we should follow. Investing all of your money in a single type of asset raises the possibility that you will lose all of your money, and it may also reduce the amount of return you get on your investment. As a result, proper asset allocation is an essential component of sound financial planning for retirement. A correct asset allocation takes into account a variety of aspects. Here are those aspects. Firstly, your age. This factor is typically mirrored in the aggressiveness of your portfolio. That is, how you are likely to take on greater risks when you are younger and fewer risks as you move closer to the age at which you can retire. Also, your comfort level with risk. This helps to ensure that should any losses occur, they will do so at a period when such losses can still be recovered, regardless of whether you need your assets to grow in value or provide income. Number 5. Consider all potential expenses. Some of us make the error of failing to account for future costs associated with medical and dental care, long-term care, and income taxes while we are making plans for our retirement. When determining how much money you need to prepare for retirement, an important step is to compile a list of all the potential costs that you will face during your golden years. You'll be able to develop more accurate estimates and plans as a result of this information. Number 6. It is required to have a savings plan for retirement. It's a good idea to save a lot of money, but the benefits of saving money will not be achieved if you cannot spend within your budget and you end up taking loans to cover your day-to-day expenses because your savings are locked up. For this reason, creating a budget and sticking to it is necessary. Your retirement savings should be listed among your budgeted regular expenses so that the amount of money you have available after paying all of your other bills may be determined precisely. Number 7. Perform periodic evaluations of your investment portfolio. A strategic asset allocation must be performed on your portfolio to allow for any necessary adjustments as you approach closer to retirement and as your financial needs, costs, and risk tolerance change. This will assist you in ensuring that the planning for your retirement is on the right track. Number 8. Optimize your expenses. If your way of life, income, or financial responsibilities have changed, it is likely a good idea to reevaluate your financial profile and make adjustments where possible so that you can change the amounts you add to your retirement nest egg. This will allow you to enjoy a more comfortable retirement. For instance, you may have finished paying off the loan for your car or your home, or the number of people for whom you are financially responsible may have changed. Another possibility is that the amount of money you owe has decreased. A reevaluation of your income, expenses, and financial commitments will help you establish whether you need to raise or lower the amount that you save consistently as a means of achieving your savings goals. Number 9. Take into account your spouse. If you are married, you should think about whether or not your partner saves money and whether or not certain expenses during retirement can be split between the two of you. If your partner hasn't been putting money away for retirement, you need to evaluate whether or not your savings will be sufficient to pay not only your own, but also your partner's costs during retirement. Number 10. Engage the services of a professional financial planner. If you do not have previous experience working in the field of financial planning and managing portfolios, it is strongly recommended that you seek the assistance of a certified and experienced financial planner. One of the most significant choices you will have to make is to identify the individual who best suits your needs. Conclusion: with planning and attention to your objective, you can reach a place where you are financially secure. Begin with comprehending where you are right now and determine your destination. You can then make progress that will steadily bring you to a place where you don't have to worry about money. Have you started making plans for being financially secured? Let us know in the comment section below. That's it for today. Don't forget to give this video a like and subscribe to our channel. Thanks for watching, and we'll see you on the next one.